Hi, welcome to the Elevate Market Chat. In this episode, recorded September 18th, 2025, Shane and I discuss the strong year-to-date performance of the major indexes, with all reaching record highs, but caution against the market's parabolic trajectory and a 101-day streak without a significant S&P drawdown. Shane shares his bottom-up investment philosophy, focusing on high-quality businesses at fair prices, like Chipotle and United Health Group, while emphasizing long-term holdings and rigorous risk control. We review the Federal Reserve's interventions, including a recent quarter-point rate cut, bringing Fed funds rate to 4.15, questioning its impact amid persistent inflation and a weak labor market. We also explore gold's role as an inflation hedge and analyze recent moves in stocks like ORCL and Intel. Packed with actionable insights, you're not going to want to miss this episode. Thanks for tuning in. Shane, how's it going?
Kyle, I'm good, man. How are you doing today?
Doing good. Just getting into the fall swing here, starting to cool off a bit, and the market does not appear to be cooling off, so we will get into that. But how are you doing? I know you were out on the golf course this morning.
Yeah, that was it was a better walk than it was round of golf. So at least I got some exercise in, and it is cooling down. It's like fall here in Florida. It's only 87 degrees today, so it's about as hot as the market.
Yeah, that's still a little toasty for me. So, with that, just talking about the market here, why don't we get into it? And, we'll just kind of recap what the major indexes are at to begin with, and then we can talk a little more granularly. So we will get into that. But, I took these notes this morning before the market opened. I know we're up about 0.5% as of the close today, but S&P 500 year to date up about 13.3%. NASDAQ 15.7, Dow Jones 8.8, and then gold just bringing it home 38.6. So if you liked gold going into the year, you were very happy at this point. But it has been a much more positive year. But then I think the sector is always important. So Shane, where have you kind of been looking for the most opportunity on your sector watch?
Truth be told, I don't really do that. I don't do too much sector, like, oh, I need something in this sector or that sector. That's just not something that goes into my normal framework. I'm definitely more of a bottom up guy. I look for the world's best businesses trading at fair prices that I can hold for as close to forever as possible. And these are the kinds of businesses that are going to do well in all economic environments, at least relative to, their peers and companies that aren't quite as high quality. We do have a framework for looking at sectors, right? We have a major macro framework that I do absolutely pay attention to, but it shifts quarterly, right? And so I'm not inclined to sell all my investments from one quarter to the next and just align our portfolio for whatever the macro environment calls for from one quarter to the next, because that's just too much trading. And you end up, looking at stocks that, these are world-class businesses. I don't want to sell, Visa simply because we're in a new macro environment. Maybe Visa will struggle in that environment where inflation is going one way and GDP is going one way, versus another environment where inflation and GDP are going the opposite ways. But like, that's only going to last for a quarter, maybe, right? And then it's going to shift again. And it's like, I feel like a lot of that is chasing your tail in a lot of ways. So, I mean, we have this macro framework that I learned from Hedge. It's not mine, and I'm sure they learned it from somewhere too, because there's hardly any new original ideas at this point in the investment management game. So when we have cash, right, like we will take the macro environment into account and use that to identify which sectors are likely to produce the highest returns. And we'll certainly look and give that a little bit of attention. But I'm just not one to be a Dorsey right sector rotation kind of guy, because it's just too much trading for me and for our clients. And I think it's good to be macro aware, but I'm not a macro economist and I'm not a macro money manager. I am just buy the best businesses and fight like crazy to never have to sell them. That's what I prefer. Of course, even the best businesses have gone through long, long stretches where you wouldn't want to own them. Nvidia's had 80% drawdowns in its history, I think. You don't want to wear that. Microsoft took 13 years to get back to even after the dot-com crash. You don't want to wear that for 13 years. So, even the best businesses in the world go through stretches where you don't really want to own them. And I'm okay selling them if I have to, but I really don't. I don't know. I really don't want to have to sell the world's best businesses unless I really, really have to. So, I don't know if that answers your question, but I'm not really focused on which sectors are doing what.
Yeah. And I think that's great. And just as an example, like you're talking about the best businesses and not chasing headlines. Uh, right before this call, you and I were just discussing one of my favorites, which is Caterpillar. And I'm not saying that's a stock that's going to the moon or anything of that nature. Just simply, I used to participate more with Caterpillar, and pretty boring name. And you look, I hadn't checked in a while, and it's up about
It's not
100% in the
Yeah,
last year.
it's not going to the moon. It's already landed on the moon. It's thinking about going to Mars or something like Elon Musk. So,
Hmm.
yeah, that thing, it's crazy when an old school Dow industrial type name starts doubling and acting like a momentum stock. You know that you're in a melt up environment when stuff like that's happening. And it's good to be macro aware and know what type of environment you're investing in, because I think it does inform you as to, how tight do you want your stops to be. Um, and can you safely buy dips in the market, and what even constitutes as a dip? Interesting things for you. Today, as we're recording, was the first day that the S&P 500, NASDAQ, Dow, and Russell, all four closed at a record high since 2021. You remember 2021, right? That was the GameStop AMC melt up mania.
Yep.
And you remember how that ended? It ended with 2022 being, the worst year in a while. Um, so that's interesting. I don't know what that means for the future, but um, it's not a good thing, I don't think. And then there's another is that we're now at 101 days, I believe, since the last 2% drawdown in the S&P 500. 2%?
Yeah. Now
Yeah.
that's a number that I pay attention to. We've just been on this kind of runaway bull market, and that concerns me a little bit. I just know from trading, think of this SMCI, I think that was the name.
Yeah. Yeah.
If you remember, that was a year or two ago. Just such a hot stock. But the thing is, once it starts to get that kind of parabolic look where it just keeps pushing higher, it gets hit with a huge sell order and 20-30% drop, or I think it went beyond that in a day. Those are the things that I think of. It doesn't mean it's going to play out, but definitely seeing a lot of kind of people jumping or piling over each other trying to get in on this one is what it looks like. We'll see what happens in the end, but
I mean, we all know what's going to happen. It's just the timing of when it happens and how far does this thing run before it happens it's really the only question. Um, but we all know how it ends, right? And I think what's really interesting, I think, is to think about after that, what does what does the government, the Fed, whoever do to save the market from going into free fall? Because so unpopular opinion, um, the stock market doesn't it hasn't had a real crash since the great financial crisis. Many stocks haven't been fairly priced, since like 2015. Um, like the market as a whole never got down to, like, if you look at the average PE multiple or forward PE multiple from the year 2000 to now, like what's the average? What is the mean PE? The last time the S&P 500 traded at or below the average was in 2015. It's been 10 years. of
Yeah,
an
that's a long
overvalued
time.
market. It's that's crazy, and it's because every time you have some like I think that in 2020, early 2023, after the down year of 2022, and in early 2023 is when you had all those banks failing, right? Silver, Silicon Valley Bank and Silvergate and New York Community Bank or what Synchrony. I can't remember what they were anymore. But then you had the Fed stepped in and bailed them out. And that, I don't think that gets talked about enough. If the Fed had not stepped in and bailed out all those banks, there were a whole bunch more that were going to fall. And suddenly, these banks could go in and trade in treasuries that were literally worth 50 cents on the dollar and get a whole dollar for them. And if the Fed had not stepped in and done that, we would have had a real situation, which would have been, it would have hurt a lot of people, but it would have been very healthy because it would have cleared out a whole lot of malinvestment that remains now in our system. And a lot of these zombie companies that can't really make any profits, certainly can't make enough profit to pay the interest on their debt. There's still tons of these things out there because we haven't let them be cleansed in like almost 2 decades, which is crazy. Makes me feel really old to say stuff like that. But I can't believe that so here's the unpopular opinion is that the S&P 500, the NASDAQ, they both deserve to fall like 50%, not 20, not, oh, bear market is down 20% from highs. That's kind of not that's nothing from here. I mean, that could happen in 5 days time. 4% a day for 5 days, we're down 20%. That's nothing compared to what should happen, which is like a 50% pullback. And then we can really go load up and buy great companies at really nice prices. So I hate to say that I'm rooting for that because I don't want to see a whole lot of our clients, get hit or anybody else for that matter. But I mean, selfishly, as a 42-year-old with a lot of time left to accumulate world-class businesses, I need one of those, man. I, I'd love to have one of those.
Yeah. And I'm same camp as you on that one. I feel like as long as I've been in this industry, the pullbacks that I've seen have been, a 20 or 30% pullback, doesn't last too long. And it's just kind of been this persistent uptrend. And not that we even have to have a big pullback, but just some sideways time. Seeing that I think would be a good thing, but we're not there. And what's interesting is talking about the sectors, which I always like to look at, and led with that question. So the strong sectors, we have consumer discretionary, infotech, communication services, and utilities. And then we have the weak sectors. So thinking, oh, those are the opportunistic ones, right? Weak sectors, they're beat down. You go into consumer staples, real estate, and healthcare, which are the weak ones. Look at the chart, and it's really the same one. Maybe they haven't kept up as much, but I don't know that there's a sector right now that has been beaten down. And that's an interesting place to be. Not a ton of opportunity in there. And I'd love to see that shake out, but it's just kind of blowing my mind, I guess, where
Yep.
everything just keeps going higher. So might as well let it do its thing. But there's should be a point and could be where we need to pull a little risk off the table, but we're not there. So it's like, hey, tide keeps going that way. Might as well stick with it.
Yep. And I mean, that's the welcome to the world of passive investing where you've got people not using their brains at all, just blindly buying whatever, is in the S&P 500 and whatever proportions the S&P 500 has them. The ones with the biggest weightings are probably up the most, just like the stocks with the biggest weightings are up the most. I just think it's a trend, and I think it's all because of passive. And the only thing I can think of for that to sort of change is um, for people to start taking money out to live on for their retirement at a faster pace than new buyers are putting money into their retirement plans, and that seems unlikely to happen until at least 2030, um, when the last baby boomer turns 65, which is just what I've been using as a proxy. So
Mm-hmm.
I don't know, could be a while longer on this ride, but I do think that this is why I like analyzing individual businesses from the bottom up is because companies are always going through whatever whatever hard time can fall on a company. I mean, you look at just some of the world's best businesses out there, and I mean, I don't know, maybe you would disagree with me on this, but Chipotle has been one of the best stocks in the market for as long as anybody can remember. Um, Chipotle is all over the place. People, burritos are never going to go out of style, I don't think. Whether you buy them at Chipotle or Taco Bell, I think does change from time to time, but I don't know. I still think Chipotle is a pretty good business. It is for my entire life, except for when it first IPO'd, has always been just too expensive. And I never wanted to pay whatever multiple it was, despite the fact that it kept getting bigger and bigger and higher multiple and higher multiple. But Chipotle recently hit an alert that I had on my chart for years. Like, hey, if it ever gets down to this level, I would buy it. It's a fair price for Chipotle, and that alert recently went off at $40 a share, and that's what I thought was a good fair price to pay for Chipotle. It gave me a good margin of safety from what I think its intrinsic value is, based on future growth and all that kind of thing. It's not a cigar butt. I'm not a value investor, right? I don't differentiate between growth and value that way. I think growth is a component of value, right? So something growing at a higher rate is more valuable than something growing at a lower rate or shrinking, all else equal, right? So I think growth is a component of value. And based on, I think, very conservative estimates of growth going forward for Chipotle, I thought that was a fair price for the stock. And so there are companies out there that I've been waiting long time to buy, and the charts look awful. They look terrible. UNH was the one we talked about, right, on the last call. What's UNH done since the last time we talked? I mean, not that I'm giving anybody advice to go buy a stock, but I don't know. The last time we talked was when? Do you remember, Kyle? End of
So,
August?
yeah, it was kind of mid-August, and we've certainly had a nice bounce since then.
Yeah, mid-August. So I mean, it's up at least 11% since then. And it's up, let's see, about 42% off of its lows in early August. So, sometimes companies that have been around for a long time, probably are going to be around for a long time, have a really, really nice, profitable business. They go on sale for silly reasons, and that's why Warren Buffett always talks about, a large but solvable problem. And
Hmm.
I think I don't know if that news came out before or after we talked, but the 13F filing showed that Warren Buffett had been buying UNH. So right behind me.
Yeah, he was taking your advice on that one, I think. So
He must listen to the chat.
must be. So
Um, but anyway, yeah, that's what I really like to look for is just world-class businesses that are going through, you know, some type of issue that causes them to be on sale, and then you go allocate a reasonable amount to them and make sure you've got your exit strategy in place before you click the buy button. That way you can unemotionally decide how you're going to exit. And you got to define what you're willing to risk, because I don't ever have any idea how much money I'm going to make on something. I don't ever
mhm.
know that, but I can be certain, relatively certain about what I could possibly lose, and so that's I wrote about that in my recent commentary. That's what the world's best investors focus on. And as long as you have a risk control in place, your returns are going to be what they're going to be. There's nothing we can do to control how much a stock goes up, but we can always control how much we lose.
Exactly. And thinking of losing and catalysts and things that might happen in the market, we had a big event on Wednesday. So yesterday, the Fed came out and lowered the Fed funds rate. Now it sits at 4.15 is the target rate. So they lowered it by a quarter point, but everybody has been waiting for that. And I'm curious what your take is on that, because the next question is, what is then the next catalyst to move the market higher? Or are we just kind of doing a little bit of a push and there's the fuel is now gone? Um, how are you viewing it, and what was your takeaway?
Yeah, well, I think there's a few takeaways. I haven't looked here since the market closed, but the first thing I did when I got in from the golf course was I wanted to see what had happened with interest rates. Um, did they go up or down when the Fed cut? And so just looking at the 10-year yield going into the meeting, rate was 4.02, and as of today, the rate's 4.07. So Fed cut rates and interest rates rose again, at least in the 10-year level. I think the 2-year did the same. But that's what happens when everybody knows that the Fed's going to cut. They are already positioned for that cut before it actually comes. So that's why people focus on what the dot plot says, right? What does the Fed collectively expect about the path of future interest rate cuts or hikes, as the case may be? And so right now, market's currently expecting two more cuts. I think two more cuts, maybe three more cuts by the end of the year. I think there's three more meetings. And I just don't think that's enough to get the market real excited about it. I think they wanted a 50 basis point cut. Um, but who knows? Speculators are going to speculate and they're going to do what they're going to do. What really was an interesting, I mean, I don't know if it's even interesting, but takeaway for me, and I posted this on my LinkedIn the other day, yeah, yesterday. So the Fed cut its policy rate by 25 basis points today, as expected. Markets pricing in two more cuts before year end. I think that might have jumped to three. So question one, why cut rates when inflation is hot and getting hotter? Answer, because policymakers are terrified how weak the labor market really is. Won't that make inflation worse? That's cutting rates into hotter inflation. Won't just cutting rates make inflation worse? Answer, yes. Pretty simple. And then the big one is question three. And isn't high inflation bad? That's the one that most people get wrong as it relates to trading stocks, investing in anything that is priced in dollars. So isn't high inflation bad? The answer is yes and no. It depends on who you are. Um, Higher inflation is devastating for those who own nothing. But for those who own assets such as stocks and real estate, it's rocket fuel. So inflation is an increase in prices. And that's what the definition has come to be. That's not actually what the real definition was, from the get-go. But we don't have time to get into all that. So most people understand inflation as an increase in prices. Well, what what do we say about a stock? What is that? That's a price, right? It's a stock price. Each share of stock has a price. And if prices are going to go up, what's going to happen to the stock price? Probably going to go up. Same thing with the price of your house. Does the value change? No, but the price goes up. And that's actually what I wrote about in my commentary 2 months ago. Is like market's full of people who know the price of everything, but the value of nothing. And so that's just the world we live in, right? And it's unfortunate because that labor market that the Fed is so concerned about is they're concerned about those people who don't have jobs, that don't own anything and can't get a job. That's who they're claiming to be cutting interest rates for. And the rise in interest rates causing higher inflation, that's exactly who it hurts the most. And that's always been true, but nobody seems to really care about it or want to point it out or shine a light on it. And of course, Chairman Powell doesn't want to talk about that in his press conferences, so probably not going to get him to answer that question. But I don't know. It seems to me like they're always talking out of both sides of their mouth, saying they want to keep prices stable for people and keep them employed, but the actions that they take are directly opposed to their stated objectives. And I don't know. I could do without the Fed, my friend. I think the invisible hand of capitalism would do a much better job setting interest rates.
Hmm. Yeah, and it's interesting to see how this all kind of shakes out, but you hit it squarely. It's inflation, it's going up. And if you own assets that appreciate, everything is great, but if you don't own assets, it's a very hard place to be in. So it's interesting to see kind of how that all plays out, but you certainly want to be an asset owner at this point and have those dollars working for you, not against you.
Yeah, yeah. Well, it's fuel for gold. I mean, lower interest rates is going to make gold go up. Lower interest rates going to make dollar go down. Dollar down makes gold go up. You know, so high inflation, gold is a hedge for. That's going to make so gold has all types of tailwinds. All types of tailwinds. So despite being up 40% for the year, trouncing the markets, being up over 1,000% since the turn of the century versus only 600% for the S&P 500, give or take. I haven't looked at those numbers today, but roughly gold's up a 10 bagger since 2000, and the S&P 500's a six bagger. Same with the Nasdaq, about a six bagger. So gold has been the place to be for a long time, and as of right now, I don't see. And Kyle, you know this. We talked about it in a private message in our company Slack. I was like, oh, it might be time to start taking profits on gold, just based on a technical kind of breakdown and a triple top. It failed to break out three different times over the course of a few months, and you correctly said like, nope, it looks like it's consolidating for a rip higher. And I said, oh, maybe. I mean, thankfully, we didn't sell any gold because nothing. I was given no reason to sell gold. Um, so it kept kind of holding that trend of higher lows, even though it wasn't breaking out. And you're right. I mean, it turned into a consolidation pattern that ultimately did break out to the upside. And anybody who wants to go look at Elevate Capital's 13F filing will see that our largest holding as a firm was a position called Sprott Physical Gold. So I don't know what else to say. I mean, it's our number one holding for a reason, and we haven't sold a single share.
Mm-hmm.
So
Yeah.
someday we'll get a signal to sell some gold, but that has not happened yet.
Yeah. And those inflation hedges, great thing to have in a portfolio. And as we've talked about numerous times, that can be gold. It can also be just stocks. Stocks go up.
Yeah,
So,
especially capital efficient stocks. You don't want to own like, you know, inefficient stocks like oil drillers and stuff like that. Those are capital intensive, and they're not necessarily the best things to own as an inflation hedge.
mhm.
But capital efficient stuff that doesn't have to constantly be reinvesting in its business to grow revenue and profits, those are the best inflation hedges for sure.
They are. And two of those inflation hedges I thought I would just mention on this call. I don't know how in depth we want to go, but just recently, talking about the AI bubble and all things around that, Oracle up 36%. I'm not sure the exact number now, but after earnings. And then Intel, that was up around 30% pre-market. So two big movers. I don't know that I had any big takeaway. I just look at the charts as always, and they look like consolidations that then broke out. And coincidentally enough, they had news behind them. But that was something else. I don't know, Shane, if anything kind of hit your radar or if it was just business as usual there.
Oh, it hit my radar all right. So I have two quick stories on both of those. First one is that Oracle was actually up like 43% that day at the highs. It didn't close that well. It was up 43% at the highs that day. It closed up 35.95%. So that was a pretty good day for like a mega cap stock, right? I mean, that is a massive move for like $1 trillion company. I think like it just doesn't, it breaks my brain. I can't really understand those numbers that big. And Larry Ellison, I think it's Larry Ellison who runs that one, right? He
Hmm.
was briefly the richest man in the world ahead of Elon Musk that day. But then I shorted the stock, and it went down a whole bunch. I am no longer short the stock, by the way. Um, but I did short it, and I made some good money because I was like like I said, the numbers just I'm like that doesn't compute. There's no way that that's legitimate, and it was all because they they missed earnings. Um, they missed sales. I think like the quarterly report was bad. Like it wasn't good. But they added all these I think it's called RPOs, remaining purchase obligations, maybe. I can't keep all the acronyms straight anymore. But ultimately, it was like we added a big backlog. Like there's all these companies that have agreed to do business with us, and that number grew by like 400 some percent. Which of course, there's no guarantee they will ever do that business, right? Like if a recession happens tomorrow, a whole bunch of those deals are going away, and they'll never make that money. So the market's treating these RPOs as if they're like as good as money in the bank. And I have seen that movie before lots of times, and it usually doesn't turn out that way. So, anyway, I thought that was a great opportunity to jump in short. Still looks like a good short because I'm not saying this will happen. It's not a prediction, certainly not a recommendation. But if Oracle completely closes that gap and falls all the way back down to, call it $241 a share, before doing whatever it's ultimately going to do, I will not be the least bit surprised. So 241 is 18% down from here. So I don't know. If you're into short and stocks, it might be something to keep an eye on. And then on Intel, this morning, the news comes out that one of their competitors is taking a stake in the business. This is after the federal government takes a stake in the business. Like Intel is just, I don't know, doesn't sound good. I don't know why it's a good thing that the government owns a 10% stake in your shares. I haven't seen the government ever do anything productive or profitable, so I don't necessarily know that that's a good thing.
And what's interesting there is they say it's a passive stake, so they're not going to vote unless there's certain exceptions, which then really just perks my ears and goes, I'm sure the government has never taken advantage of a unique circumstance.
Right.
So I am certainly not a fan of the government owning public companies, but my 2 cents there. So back to what you were saying.
They'll go lean on them. Like, hey, we're not voting, and they'll just lean right on them to do. Oh, can you please build this here? Can you do that for me? We're not voting, remember? But can you do this for me? Yeah, I'm pretty sure that that's how the mafia would invest too. Yeah, we won't vote, but we'll show up in your office anytime we want. You know. But anyway, yeah. So just to I don't always get things right, and just evidence of that was this morning. Our good buddy Kyle Eddie sends me a text message, and he says INTC, which is the Intel ticker symbol, and a rocket emoji. And I'm on the golf course, and I look down at it, and of course, I stopped out of my Intel position yesterday during the Fed meeting. So yesterday, I owned a nice piece of Intel. This morning, when it was up 30-some%, I owned no Intel. That's heartbreaker. I missed it. Brutal.
Yeah.
So it happens, man. But like I said, I'm way more focused on managing the risk. I know how much I'm willing to lose, and I try not to lose a penny more than that. And so when I hit my stop, I'll get out. And sometimes that's exactly what happens is you stopped out, and the next day the stock's up 35% right in your face. And you're just like, why do I follow stops? But trust me when I tell you, if you go back test it, being laser focused on managing risk is absolutely the right thing to do, even though sometimes stuff like that happens. So
exactly. And it's always so easy to look at it and say, oh, well, I would have made, X dollars had you stayed in. But the entire time, start to finish, there's the emotional battle as well. And it's always the question of, could you have withstood the emotional turmoil that goes along with it as well? Yeah. So in the grand scheme of things, it's just simply, hey, if we can just win more than half the time, respect those stops, it's going to be good in the end.
Yeah, well, and the headline could have been the opposite, and it could have been down 35% this morning, and I'd be like, man, thank God I follow stops. So you just never know. It's the risk I choose to take, right? I choose to take the risk that I'm going to sell right at the bottom, right before things start getting good, and that is a risk I would rather take than just bag holding a dog, for weeks and months and years. No, thank you. Yep. I've done it. That's how I know I don't want to do that, dude, is because I have done that. I have made all of those mistakes way more times than I care to admit. And I'm sure you have too. And that's how we know, because we've done it.
That's exactly it. And that's what we get to apply when we do manage money is, shared experience that we have been through it. The difference being that, when you're disconnected one level further and it's not your money, you can think a little clearer and obey those stops
Yeah.
more religiously than you might otherwise if it was your own. So, always something to keep in the front of your mind when you think about how you manage your money or working with somebody else. So, but Shane, I think with that, we've kind of wrapped up what we came into this call hoping to discuss. And I know that you're probably tired from golf and it's getting to be the end of your day there. So I can let you, part ways here. But thanks again, as always, for hopping on here and talking markets with me.
Yep, my pleasure, Kyle. We'll talk to you next month.
Special thanks to our audio engineer, Stephen Crowley, for mixing this episode. This podcast expresses the views of Shane and I as the date indicated and are subject to change without notice. Elevate Capital Advisors has no duty or obligation to update information included. All information is for educational purposes only. Certain information concerning economic trends and performance is based on information from sources deemed to be reliable and has not been independently verified for accuracy. Wherever there exists potential for profit, there's also the risk of loss. This podcast may not be copied, reproduced, posted in whole or in part in any form without prior written consent from Elevate.